I wanted you to know now. I'm very proud.
Tell him the gear is down and we're ready to land.
There will be no soft landing. There will only be a hard landing. And in order to survive a hard landing, you're going to need hard money. Hey guys, Rafi here from the Endgame Investor, and today we're going to talk about so much for a soft landing.
You're coming in too fast.
I know.
He knows. All right, now everybody, get in crash position.
The Fed basically admits that all of its talk about a soft landing has been crap. Who would have guessed that from this chart? From the top of the NASDAQ bubble in April 2000 to the bottom over here in 2002. And here you have the 2008 little tiny little sell-off there. And here, I don't know what the hell you have, but it's not going to be a soft landing. Now we can go to the Financial Times, where we have an article that basically admits that the Fed understands that there is no soft landing, and everything that they have said before this has been a lie. Fed warns of negative feedback loop as market liquidity deteriorates. Technically, that's untrue. It's actually a positive feedback loop. What they mean is a positive feedback loop of negativity, because a negative feedback loop is when systems balance themselves. But anyway, that's just a technicality. U.S. Central Bank says a sharp rise in interest rates could cause a large correction in asset prices. Really? That's what they say? Ha! Here's the first paragraph. Dramatic price swings in U.S. financial markets have probably been exacerbated by a decline in liquidity, the Federal Reserve reported on Monday, as it warned of a higher than normal risk that trading conditions will suddenly deteriorate. The Financial Times financial correspondent also reports that the sky is blue, and for some reason, when you throw things up in the air, they tend to fall. Speculators believe this has to do with the curvature of space-time known as gravity. I am not of the school of thought that believes that algorithms are a problem, or trading algorithms are a problem. They are simply tools like any other tool, and to decry a tool as changing the fundamentals of how things work or how markets work is a version of the Luddite fallacy. The Luddites were people, a group of people, a movement that was against automation of different work, whether it be from the wheel or any machine that makes labor more efficient, because they believed that efficiency destroyed jobs, which is a fallacy. What do you have? Want to see higher than the camera? Okay. If trading algorithms were really in charge of prices, then we'd see shortages and surpluses everywhere, which we don't. And the reason we'll see shortages soon is because the money is dying, but that's a different issue. But there is something about trading algorithms that I think is going to become an issue very soon, if it hasn't already. And by very soon, I mean within weeks. You see, trading algorithms did not exist 41 years ago in 1980, 1981, when the bond bull market began. So every trading algorithm is programmed to behave as if bonds are in a bull market. That means when stocks sell off, algorithms are programmed to buy bonds, generally speaking, as a safe haven asset. But once technical patterns break trading ranges, and technicians have to admit, human technicians have to admit that bonds are now in a bear market, then they have to alter their algorithms. And nobody in the history of the world has been involved in a market where trading algorithms are operative in a bond bear market, because trading algorithms didn't exist during the last bond bear market. So what happens when traders alter their trading algorithms, and when stocks go down, instead of bonds being bid by algorithms, they are sold? You could have a situation where algorithms don't know what they're doing because they have never been in this environment. By what I mean, algorithms don't know what they're doing. Their programmers don't know what they're doing because they all have to reprogram them independently. So you could have some serious destabilization in bonds, especially if they break trading ranges, which they already have. And I'll show you that by these lovely charts. Here is the chart of the 5-year Treasury yield. We have a trend line break.
We were on a break!
Going back to 1994, the last bond market crisis, but it's not just the 5-year, it keeps going. Here you have a 7-year Treasury yield trend line break.
We were on a break!
And here's the all-important 10-year Treasury yield trend line break.
Oh my God, if you say that one more time, I'm gonna break up with you.
It goes out to the 20-year. Here you have a clear break in the 20-year going back to 1994. Here is 3.43, and here is the obvious break. This is going to get the attention of algorithm programmers who are humans who are going to change the programming of the algorithms they use to trade bonds. And finally, the 30-year also breaking out at 3.23. But let's go to the scariest chart of all, or the most encouraging chart of all, depending on your Weltanschauung and your philosophy and your outlook on the global economy and life. This is a chart of where I believe the end game must kick in. See here, this is a trend line of the federal funds rate since 1987. This is the 1987 market crash, and when they started cutting rates very aggressively. Here is the 2000 NASDAQ bubble. Here is the 2006-2007 housing crisis. And here is the repocalypse, September 2019 repo crisis, where rates suddenly skyrocketed 10%. They had to start cutting interest rates again. And here is, of course, the COVID crisis. Now, this trend line in Austrian economics teaches that in order to sustain a bubble, this is just plain logic, in order to sustain a bubble, it must keep growing. And in order to keep growing, you need to pump more and more air into it. So what sustains a bubble is not low interest rates in an absolute sense. It is constantly falling interest rates. So if you go above a trend line, the bubble starts to pop, and the central bank must continue to print more money and lower interest rates further and further, and they can raise it up to where the trend line goes. Is it exactly the trend line? Is that the science? No, but it is a general heuristic that I'm using here. But it looks like, from historical precedent, from empirical evidence, that the Fed will not be able to push the federal funds rate above this line, which is about 2.2%. We are now at 1%. So going at 50 basis points a hike, which seems to be what they're doing, we have about 2 to 3 more rate hikes until the entire system implodes and they have to reverse for one last time, and gold and silver explode and the dollar dies. That is somewhere between July and September of this year. What happens after that is the end game. What happens before that is some rockiness in the gold and silver markets. And if you are not prepared to handle it and buy the dips, then you are not going to survive this market. We are in year 50 of this fiat monetary system. It almost exploded in 1980, and the only thing that saved it was a hike in interest rates to 20% by Paul Volcker. This time, they won't even be able to go above 2.5%. There will be no soft landing. There will only be a hard landing. And in order to survive a hard landing, you're going to need hard money. If you haven't gotten your gold and silver yet, you are going to have one more chance. During this coming liquidity crisis, it is likely that prices will fall for the last time. If you haven't gotten rid of your Bitcoin yet, now is the time to run away. This is Rafi of the Endgame Investor. If you enjoyed this video, then subscribe for a 2-week free trial of the Endgame Investor, and you'll see what I have chosen to short, among other things. And if you are interested in a biblical commentary on economics and monetary topics, then sign up to be my patron on Patreon for as little as $3 a month, where you'll get a weekly video of biblical commentary on financial topics and the relationship to God, morality, and religion.
It's you and me, all right? This is it.
This is it. Unless we're on a break.